Ever noticed those massive candles during major news events or volatile market moves? They often leave behind these huge wicks, like the market stretched too far and snapped right back. Those wicks aren't just noise, they're clues. And knowing how to trade them can be the difference between a win and a loss. That's exactly why we built an indicator that automatically detects these large wicks for you and marks out the key support and resistance zones they create. And we're giving away this indicator for free. So let's dive in, because this might just be the edge your trading strategy has been missing. Let's first break down what wicks actually are. Each candle shows the open, close, high, and low of price movement within a given time frame. The wicks represent the price extremes. At a one-dimensional level, many traders often use these wicks to help identify candle patterns like the doji formation or tweezer tops and bottoms. But there's more to these wicks than just surface-level formations. If you were to zoom in on one of those long wicks, you'll often find they represent retracements of lower time frame moves. And based on the principles of market structure, many of those wicks tend to get filled later on. But here's the challenge. How do you know which wicks are meaningful and which ones are just noise? That's exactly where our custom indicator comes in. When you first add the indicator to your chart, the most noticeable elements are the green and red horizontal lines stretching across the screen. Red lines mark significant bottom wicks, and green lines highlight major top wicks. You'll also see that the candles themselves look different. That's because, by default, the indicator uses something called wick-based transparency. This setting makes candles with smaller wicks appear more transparent, while candles with larger wicks stand out more clearly. It's a smart way to visually emphasize areas of volatility. But how does the indicator decide what counts as a large wick? That's where the settings come in. If we go into the settings, the first option is the wick threshold, and this controls the sensitivity of the detection. Lower values detect more wicks, while higher values filter out all but the most significant moves. Next is the level percentage setting, which defaults to 100%. This determines where the wick level is drawn from. At 100%, the level is placed at the very high or low. Reduce it to 50%, and the level is drawn from the midpoint of the wick, useful depending on how you'll be using the indicator. Then there's max duration, which sets how long a level stays visible on the chart, useful for hiding older zones that may no longer be relevant. The next toggle is mitigated wick. If this is disabled, any wick level that price has already interacted with will be removed from the chart, helping you keep things clean and focused. Finally, under the style section, you'll find two key options: wick-based transparency, which we covered already, and breakout-based color. This one adds another layer of clarity. If enabled, the indicator will color candles based on the most recent wick level that price broke through. And now that you have a good understanding of how this indicator works, let's see how it can actually be used to execute trades. Now, one of the most effective ways traders use wick zones is as target areas. Take this example. The market breaks structure and forms a higher high, but on the pullback, it leaves behind a significant wick, which our indicator flags in real time. Now, if you look closely at the price action next to that wick, you'll notice a large, clean candle. That's important. It tells us price moved through this area easily before, without much resistance. This makes it a prime target for a short-term retracement trade. To trade this setup, we'll activate the Signals and Overlays toolkit. We start by disabling both candle coloring and Smart Trail, and then turn on the short-term autopilot. Now we simply wait for a bearish confirmation to form, and we'll set our target at the low of that wick. Once we get to that wick target, watch what happens next. It sharply reverses. That's a strong clue. It shows how these wick zones often act like magnets for price, but also as reversal points once filled. The key takeaway? Always consider the surrounding price action when using wicks as targets. They not only highlight volatility, but can help pinpoint short-term opportunities with precision. Here's another great example. This time, we're trading in the direction of the overall trend. We see the market is trending higher, confirming bullish momentum. Then, a large wick appears, immediately detected by the indicator. As we touched on earlier, large wicks often represent retracements on a lower time frame. So let's drop down to a lower time frame to see what's happening. And now, it's clear. The market continues to make higher swing highs and lows, and that wick pullback, it's just a healthy retracement. And once more, notice how a large, clean-bodied candle forms during that push to the upside, which we're now retracing into. Once price clears that candle and a bullish candle starts printing, the entry becomes obvious. We can place our stop loss below that candle's low and target the wick level above. Simple, effective, trend-aligned. And that wraps up our deep dive into the Long Wick Detector, a powerful tool that transforms overlooked price extremes into actionable support and resistance zones. You can add it to your chart right now, completely free, inside the LuxAlgo library at luxalgo.com/library. And if you're looking to sharpen your entries around those wick zones, the Signals and Overlays toolkit we used alongside it is also ready for you. Risk-free for 30 days at luxalgo.com. Thanks for tuning in. Trade smart, stay sharp, and we'll catch you in the next one.